as Aftab said, I relocated to Dubai for S&P in October this year. And in the middle of November, I think, my wife and I said, well, let's go out for breakfast one Saturday morning. We knew where we were going to go. It was a relatively awkward location we were getting to, somewhere specific. We turned up. Turns out they open at 10 o'clock in the morning. We were there at 10 to 10. We weren't going to drive off somewhere else for breakfast. At 10 o'clock, the staff arrived. Inside the building were two chefs that had taken delivery of everything that they required for breakfast, but they couldn't open the doors. And so there we were, their two clients, first ones of the day. We were outside, waiting to get in, have something to eat. They just could not open the doors to get us in. I don't know how the other two staff that were in the building were entered in, but we, the clients, could not get in. And the man who was going to serve us couldn't get in either. So we drove off and had a protracted journey to go somewhere else. Well, is that key man risk? It's certainly an operational risk. I think if the chief executive of that food franchise resigned that morning, that would not have impacted my ability to buy my wife breakfast for 50 dirhams. But the fact that I couldn't get through the door because they couldn't open those doors was an operational risk, and they will not be getting my 50 dirhams this week, and they won't be getting it next week. So you put the risk that you're exposed to into context. Now, one at the bottom. I will elaborate upon investment risk later on, but clearly investment risk covers the credit risks that you're facing, the market risk you're facing from where those investments are placed, and your ability to service the liquidity demands of the business from that chosen investment portfolio. We expect a company to have rational tolerances for these risks and appetites for these risks that work together, that we can see regular reporting upon, monthly reporting, quarterly reporting, informal reporting will do. But we want to see some mechanism that's delivering to us that the risk framework the company is exposing itself to is considered and managed. Emerging risk controls. What is the format for identifying unexpected events for the company? I don't expect us to go into every company and see the topic emerging risks and a list of things that have been considered. But if the management team is meeting every Monday morning, every Thursday afternoon, that is an opportunity for the management team to work out the events that are likely to impact the company. This morning, I think I saw a reference on the news to an influenza pandemic. I'm reminded that a few years ago there was a bird flu risk that was bouncing around. Then we come back to the usual catastrophes that can be expected. Having structured a risk recognition framework and usually put it in writing in some form of risk register and appetite and tolerance reference point, we turn to the risk models that the company is setting. We could stop at the emerging risk controls and say, well, that covers the risk management framework of the company. But once you start to model those varied risks in some fashion and link them together to each other, you then start to move into the more complex areas of risk modeling that typically actuaries are involved in these days. And ultimately, you move into strategic risk management, whereby you're deciding that the capital you have in the company needs to be allocated in this area in order to support that level of risk, as opposed to putting it somewhere else. In the modern GCC insurance market, would you invest capital in the medical sector? Would you invest capital in the motor sector with the types of returns that we're seeing in those marketplaces? Well, maybe that choice isn't one that you can make, but it certainly makes you think if the capital you have supporting part of your franchise is actually not delivering a return upon it, what are your shareholders actually doing it for? So, here's how it works. Companies set the risk appetite. They set a planning and limit framework. They devise policies and processes that monitor and report upon that framework. There is then feedback provided as a result of that monitoring process. To give it another set of words, they plan, they act, they review. If there's any sort of business framework, comes up with the same process. Make a decision, you rationalize that decision, what has come as a result of that decision, and you then adjust the processes. So when we're looking at risk management, enterprise risk management, we want to see how the risk management of an enterprise has been developed over a period of time to prove that it is actually working for the entity. So here we have risk appetite, a clear statement about the risks management that they're willing to accept. That risk appetite is used to establish the business plan and the risk limit framework. Set out the policies and practices that enforce that framework. Regular reporting. Exposure versus the limits. How are breaches of the limits dealt with? Feedback information on exposure and business profile to the risk appetite. Typically, what we expect is that the risk appetites and the risk control framework belongs to individuals in the organization. So there is a tangible financial involvement of the owners of the risk in adherence to the risk framework. Let's develop some thoughts on that. Corporate governance is clearly part of the risk management framework of an organization. So we want to see the clarity of roles and responsibilities for the different board committees that we see, and that there is a complete, coherent committee structure that the company is working to. We expect to see a clear statement of risk preference and risk tolerance, something that we can walk away with and say, this is the risk tolerance they are taking on this particular aspect of their activity. Have they delivered on this in 2006, 2007, 2008? And roll it forwards and see how has that been adapted over the past 3 or 4 years in the light of actual incidents. Emphasizes the length of time that we need to look at to get comfortable with an ERM program that a company is delivering. What is the reporting framework for that? How regular is the risk reporting? Is there a chief risk officer on board? A number of the markets that we are providing ratings to now in Europe require a company to have a chief risk officer. Probably not something we see much of out here in the Gulf region. 1 or 2 individuals carry that title. And I think it depends upon the complexity of the organization as to whether a standalone individual with the title Chief Risk Officer is required. But we need to see some means of delivery on that. Are the metrics of risk easy to read and understand? Is the audience getting useful information that they can work with? That there are minutes for all the meetings of the Risk Management Committee. That the risks and the monitoring is in compliance with policies and procedures. Staff remuneration in line with the risk metrics. Typically, there are individuals charged with owning the risk framework. The motor underwriter owns the performance of that. His remuneration will be based upon the delivery of a performance within that risk framework. There is staff training on risk management in the organization, and that staff training encompasses the whole of the staff. Risk management is not the responsibility of the management team, it is the responsibility of everybody. Also, an important aspect, the risk function has a say in the decision-making process. They can intervene in the risk-taking process. This is what makes it enterprise risk management, that it covers all aspects of the business. Gets away from the silo mentality that organizations today still work with. So we have a clear statement of risk preferences, a statement of the amount of risk in the tolerances, and we translate those into working risk limits. And in our assessment, we look more favorably upon those organizations that have a risk appetite set with the engagement of the board and the senior management, that risk appetite is communicated and understood throughout the business, that there is regular reporting against that risk framework, and that the governance structure of the organization and the remuneration policy of the organization is linked to the risk appetites. It's important that the people who are delivering the risk framework are remunerated in accordance with it. So, S&P has a more favorable opinion on risk controls where there's a clearly defined risk appetite, clearly defined tolerances, and there's a limit framework consistent with clear ownership of the risks. You have an investment manager. What is that investment manager's job? How is success measured for that individual? What is the volatility framework that he has to work within? There are policies for each type of risk explaining what can or cannot be done. Exposure constraints and the control within those risk tolerances. That there is monitoring of the compliance within the policies and the limits. If there are breaches of the risk framework, how are they dealt with? Who makes the decision for some disciplinary action or a corrective measure? It doesn't mean to say that a risk breach is serious. It needs to be monitored and determined whether it's a fault of the planning process and a fault of the decision-making process, that there is some means of recognizing it and a correction is put in place. That you have robust tools to control those risks, and as we've said before, that the risk management reporting is clear, focused and frequent. Let's talk about the complexity of the risk framework. If you're an organization writing $2 billion worth of gross premium, you're probably writing a fairly diverse book of business. If you're an organization writing $200 million worth of premium, you're certainly smaller. You're probably writing a less diverse book of business, so you have greater levels of risk concentration within that. The perspective S&P is taking is that risk management needs to be appropriate for the organization. If you are an organization writing a diverse book of business, diverse in terms of geography, and or diverse in terms of risk types, then the complexity of the business model you're following is inherently greater. So the requirement for risk management is probably greater. And the benefits that you can obtain from enterprise risk management should be greater as well. If you're a small organization, $200 million of the premium, 150, 200 employees working from one office site in one geography, the chief executive probably knows everybody in the building by face and by name. There is an implicit level of risk control and management that can be deemed to be present within that organization. But if you have an operation headed in London with operations in Chicago, Rio de Janeiro, Shanghai, and Tokyo, how would you know that those distant offices are actually working in accordance with what you want them to do? So whilst the ratings profile that S&P delivers looks for greater stability, that stability needs to be measured by reference to more sophisticated risk management techniques within those organizations. So when we're looking at an organization, a good understanding of the risk models, capabilities, and shortcomings is to your benefit from a rating perspective. You understand the business that you're working within. Is the risk model that you're using designed proportionately to the level of risks?